Good afternoon, ladies and gentlemen. A very warm welcome back on Business Edge Television in our special series of Market Masters. Especially today, it's a wonderful day to welcome a market veteran of the past 30 years, a very well-known fund manager who looks after 4 lakh crores in terms of asset under management and has a stellar record in creating wealth for his unit holders, not only in bull markets, but also in volatile and bear markets. It's a great pleasure to welcome Mr. Mahesh Patil, CIO for Aditya Birla Sun Life Asset Management Company, on such a day when Nifty itself is up 3.5%, the IT index is up 6.2%. We are celebrating the comprehensive military victory of India over the Pakistan military. And there are a lot of positives that have emerged over the last 10, 15, 20, 1 month or so as far as the macro picture is concerned. Namaste Mahesh ji, and a very warm welcome to you, sir. How do you see sentiment in Dalal Street, in particular today and over the next 1 year or so? What are the positives that have emerged over the last 6 months?
Yeah, good afternoon to everyone. Indeed, today is a kind of an important day, okay, not only for the markets, but also for the broader outlook from here, right? So the domestic geopolitical risk, which was one of the factors which was emerging and kind of weighing down the market, I think that seems to have kind of abated. Also, what we hear is that Russia, Ukraine also, okay, they are also looking at some kind of a ceasefire. If that also works out, and I think on the global front also, you will see the risk premium which was there because of the geopolitical risk will kind of come down. And then, more importantly, I think the developments, okay, since the Trump announced his tariffs, right? The markets were taken by the shock because of the quantum of tariffs which was there. But since then, we have seen things have kind of mellowed down. And Mr. Trump, he's trying to negotiate deals with various countries. We saw a trade deal with the UK a few days back. And today, most importantly, with China, okay, which is the largest trading partner of the US. We've seen that they have come to a terms which the tariffs now with 30% tariffs which was there, which is kind of much better than what we were expecting. So I think that would really be positive even from a US perspective in terms of the fears which were there that they could lead to a lot of disruption from the supply side. You could see inflation go up. So I think given all these factors, I think some of the concerns which were there, I think those are kind of easing off. And I think the market, for India perspective, if you look at it, so we are coming out from a slowdown, right? So last year, FY25 was a year of a slowdown for us, both from a economic perspective as well as from an earnings growth perspective for the companies. And that was because of the tighter monetary policy which was there, the government spending which was lower, and all these factors. And as we step into this fiscal year, right, we've seen that on both these conditions, the financial conditions are now much easier. The RBI policy, what we've seen the last couple of policies, has been very accommodative and supportive for domestic growth. More importantly, the liquidity situation, which was negative around 2-3 months back, now that's well into very positive territory. And we have seen rate cuts also, which have happened to rate cuts. And more to follow, at least another 2 more rate cuts is what we look into it. And as a result of that, also the banking system, which is getting throttled a bit, not only because of tighter liquidity, but also because of the restrictive conditions which were the regulatory, those have also been kind of eased off by the RBI. So I think all these factors should help us to growth to slowly come back. And this year, I think we can expect earnings growth again to go back into double digits is what we would expect. And that should, I think, put the way for the markets, right, from here on to really scale new heights.
Okay. To this, from my side, I add record GST collections for the month of April to the tune of more than 2 lakh crore rupees. CPI inflation below 4%, and who would have believed oil prices at a 4.5 year lows. All this put together, ladies and gentlemen, creates a very nice risk on trade as far as India is concerned. And this is the reason why, for many other reasons put together, we celebrate the Nifty posting its best single day rally since February 2021. now 3.5% higher. Mr. Patil, I'd like to take your view on the defense space. I remember very distinctly in the last 10-12 months, a defense fund was launched by Aditya Birla AMC. At that point of time, the markets were at a record high for those stocks, but they have eased. Now, given the conflict that has gone by in the last 4 sessions, how do you see the defense industry at this point of time? Are there any lessons that we have learned as investors from investing at the previous peak, or are the valuations good enough for you now?
Yeah, so the defense sector, okay, had, a year back, okay, we've seen a sharp rally prior to that because of the opportunity. Clearly, the defense sector is going through a big transformation, okay, which is one is the domesticization, right, in terms of trying to procure more from indigenously. We've seen that slowly getting increased, and that's the target of the government, which has opened up better opportunities for a lot of the domestic companies. Though our defense budget hasn't really gone up too much, right? So that's been growing at around 10 to 12%, which is not such a dramatic increase. In fact, that is something which could be questioned now. I think in the backdrop of this kind of an escalation, what we had, okay, with Pakistan, I think the national security of a country is of prime importance. And in that context, I think there could be some more pressure in terms of trying to increase our defense spend, which is, I think, we're slightly on the lower side. Because a lot of the spend goes into revenue expenditure in terms of salaries, but actually what you spend towards capital expenditure is not really increased meaningfully. So I think with this backdrop, I think there is a chance that you might want to secure India's overall security, and that can lead to increase in the spend, okay, in the budget. Okay, that's probability. I don't know, but I think clearly, I think when we had launched that fund, while the valuations were higher at that point in time, we
Yes.
were seeing that structurally, right, in the defense sector, there is going to be an opportunity for Indian companies, okay, to start manufacturing over here, but also to cater to the global market. In certain items, India has got capabilities and got size. And looking at the geopolitical risk globally, there was a market which was emerging for Indian companies to also export. And that was the broader story. I think post that, we had seen a correction in some of these stocks, which were expensive. But I think now, I think they have come down and are at slightly more reasonable levels. And I would guess that this is a sector which is likely to see further growth in the coming years. And I think for a long-term investor, it can still be a reasonably good sector to fund to look at.
Okay. Mr. Patil, ever since the markets corrected between September 2024 to March 2025, domestic investors renewed their faith into Indian equities and retained their SIP investments. Now, with this background that you've mentioned on the macro level improving dramatically for risk on trade, where do you think are 2 or 3 sectors where this money is either deployed or getting deployed?
So in the recent past, we've seen prior to that a couple of sectors, okay, which were had underperformed earlier, right? One is the banking and financial services sector. In the last 2 3 months, we have seen good amount of money coming into that space, primarily from more recently, I would say, from the foreign investors, okay, who had pulled out a lot of money from the banking and especially from the large private banks. We've seen that those coming back, especially in the last couple of weeks. And I think the outlook for the sector, especially from a regulatory standpoint, okay, the conditions which were there, which were pretty onerous, kind of easing off. I think that has seen this sector outlook improving. However, the overall credit growth and deposit growth is still kind of trending lower, but I think that is likely to improve. So that one sector, I think, which has clearly see higher allocations, especially from the foreign investors. But I think going forward, I would say that some of the domestic facing sectors like consumption, more so discretionary consumption, which has again was weak last year because of uh, rural economy was still not really picked up prior to the what was pre-COVID levels. I think that is likely to do better. Monsoons this year again look to be good, but more importantly, with inflation, food inflation coming down, the real
Right.
wages, rural wages, are now looking positive. So we think that also the budget has been more supportive to consumption, right? With the tax cuts, what we saw, right? And also next year you will have the pay commission for the government employees, the PSU employees. So we think that consumption and discretionary consumption will slowly pick up, and that could be a sector, okay, which could possibly attract flows going down the line. And then apart from that, I think the power sector, like power T&D space if you look at overall the capital goods sector, that's a sector where we are seeing a step up in investments, both in renewable as well as in the conventional coal-based power. And some of the companies there in that sector should continue to see a good increase in the order book. So that's on the industrial side. And pharma, healthcare, domestic pharma and healthcare are another sector as a defensive. I think that continues to be a good area which is seeing growth because of some move from even unorganized to organized, which is primarily the diagnostic space and in the hospitals and the healthcare sector.
Okay. Mr. Patil, we've just got some information coming in on the US China deal where both parties have reduced punitive sanctions. Punitive tariffs against each other, and in that connection we have Mr. Scott Bessent, US Treasury Secretary, saying this. Let's hear this out and then we'll talk more about this very important deal that has happened for all global markets. The PCR may kindly play it out, please.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. The consensus from both delegations this weekend is neither side wants a decoupling. And what had occurred with these very high tariffs, as Ambassador Greer said, was the equivalent of an embargo, and neither side wants that. We do want trade. We want more balanced trade.
So this is what I hear. Both countries want more trade, more balanced trade. They are not looking to decouple, and of course they are not looking at punitive tariffs any longer. Mr. Patil, against all this background, the best performing sector today is the IT space. Is there a correlation that you can draw between the US-China trade deal and of course this 6% uptick on the index itself?
Yeah, I think the trade wars, okay, when they started and the huge tariffs which was imposed, especially with China, I think that led to a concern that, okay, that can disrupt the supply chain. You'll see inflation going up. Fed will then take more time to cut rates. More importantly, impact on the US economy, okay, which could be there, which could get into recession. That was a fear which led to the IT sector underperform in the last 2-3 months. And that was one of the factors. And also, we've seen a large amount of money moving out of US assets into other emerging markets, right? On back of that, I think with the trade deal, and China is a large partner, and because of the uncertainty, there was a lot of, a lot of supplies had stopped down, and that was a clear fear about supply side shocks coming in into the economy. I think with more clarity coming in and with this trade deal which has been signed, I think that eases off those concerns, and hence the much big negative outlook which was there on the US growth, I think that will probably kind of mellow down, and you could see a better than what one would have expected early. And IT sector being directly linked to the US growth to a large extent is seeing a rebound on that front, I would say. And again, the sector also had underperformed significantly. The valuations there were now at more reasonable level. A lot of these companies were still generating good cash flows. They're giving good dividends. So dividend yield on some of these larger names had come to very attractive levels, anywhere between 3 to 4%. So I think that was providing a natural support. And with this positive development, I think we've seen these stocks reacting positively to that. So I think that's good. I think for the IT sector, which was seeing some downgrades, we have seen some downgrade to growth for this year. I think with this news, at least the downgrade cycle seems to be over now.
Fair point. I think that's very well explained that domestic IT is a function of US growth, and US growth was a function of the US China trade deal. Once that deal is stuck, risk on trade on US assets improves, and therefore, as do the prospects of Indian IT companies. Let me just check what the dividend yield on Infosys is at the moment. Remember, it's 2.74% after 7% uptick today. So yesterday would have been much better, and this is what Mr. Patil is alluding to, that the dividend yield itself on these wonderfully managed debt-free companies sitting on billions dollars worth of cash was so high that this rally that you see was in itself something that was in the offing. With this background in mind, do you see the risk on trade for equities emerging back in fashion, Mr. Patil?
I think we've seen probably all the concerns, right, which were there in terms of the growth slowdown, in terms of inflation, geopolitics. All these, I think the market has digested, and we are actually coming out of that phase, right? So, and more importantly, from India perspective, as I mentioned, we have seen that shock of slower growth last year, and on that base, I think we are looking at better growth, especially in the second half of this fiscal year, right, where the base would also be supportive. And a lot of the measures which have been taken by the government, the RBI on the monetary side in terms of reducing interest rate, increasing liquidity, normally it takes 6 to 9 months for that impact to flow through into the economy. And I think we should see that coming in the second half in a bigger way. So I think given that, and also now on the global front, I think as we see more trade deals being signed, I think more importantly, I think the US and India, I think also would be signing a deal shortly. I think that will clear a lot of the clouds, okay, which were there, and that would mean that the risk appetite, at least the risk for investors, should come back. That doesn't mean that the outlook in terms of growth or earnings growth really changes dramatically, but at least the risk premium which was being attached to some of these things, I think that will come down, and that in itself would mean that the money flow into risk assets can improve. We've already been seeing money coming into the emerging markets in the last 1 month or so. That was a welcome trend, and that's the reason why we saw FIs turned positive for the last 15 days. We've seen that. And I think that was, I think with this scenario, I think you would see that further improving, and that could really give more legs to the market from here.
Okay, fair point. How about the rupee? Do you think the recent appreciation that we've seen is now more or less done? What is your outlook on this currency for 2025?
So the rupee, again, is more linked, okay, to one was the US dollar itself, right? That, okay, had kind of depreciated against all the currencies, and we saw the DXY, right, moving all the way down from 108 to below 100 once these tariffs were announced, because clearly they were factoring in a slowdown in the economy in the US. Also, a lot of money moving out of US assets, right, especially in the US bonds, as US bond yields moved up, okay, into back into the home currencies. So that was one of the trade, and we saw that as a result, the rupee also rallied, though it didn't rally as much in some of the other currencies what we have seen. I think going forward from here, I think with this trade deal and some of these things being signed, I think the pressure on the US dollar, which was there, okay, in terms of it depreciating, I think that should kind of now ease off a bit. So I would say the rupee should stabilize over here,
Yes.
and I think and try to consolidate over here. Over a medium longer term, I think you could see some depreciation in line with the fact that the inflation differential between India and the US, India still inflation is slightly on the higher side. You should see that depreciate. But I think by and large, I think should remain stable over here. I think we've seen in the last 2 3 years, rupee has been relatively fairly stable. The volatility has been lower. I think that situation should continue because we're in a fairly comfortable situation on the forex side, and with the oil prices coming down on the current account, we are fairly comfortable. Our forex reserves are also fine. So I would say that I would not expect any further kind of an appreciation of the rupee from it. It should, I think, start to consolidate over here.
Okay. Mr. Patil, Birla Asset Management Company also runs a lot of multi-asset funds and uh, uh, ETFs focusing on gold. What is the house view on this precious metal since the much awaited target of 1 lakh rupee per tola has been hit? What now?
We've always been saying that asset allocation, okay, is important. Each asset class goes through a cycle. Over a longer term, if you're able to diversify that and play that cycles, then you are able to benefit from the underlying asset class expected return and reducing the overall portfolio volatility which is there. And that by logic, we've been mandating that in our asset allocation fund, typically we're targeting around 65% equity, around 15 to 20% into precious metal, which is gold and silver, and balance into fixed income. Now, I think on the gold, I think there are two dynamics. One is on the demand side, besides the normal demand for consumption, which is that we've seen a increased demand from the central banks, right, to shore up their dollar reserves as they some of gold reserves as they move away from dollar. Especially China. China has been a big factor over here, which is trying to build its uh, gold reserves. Earlier, most of their surplus, the trade surplus with the US, which was there, was parked into US treasuries. Now, with these kind of some tensions, okay, with the US, and they have tried to move away from that, and that has led to a additional demand for gold, which has made the gold prices move higher. I think that trend will continue. China will still wants to beef up their reserves, and given that, I think the gold should remain fairly stable. But I don't
Okay.
see big upside from. We don't see any much big upside from here. Already, the gold relative ratio, if you look at gold vis-a-vis equities and other asset classes, that is on the higher side. But again, it's always better to have some allocation in your portfolio, okay, which we have seen in the last 1 year, and it's been handsomely rewarded, and it has kind of compensated for the lower returns on the equity side. And I think that kind of play for gold as a precious metal and as an investment class, I think would continue to be there. I think overall the outlook still remains fine, but don't expect the returns what we saw in the last 1 year.
Okay. Mr. Patil, when you look at the overall 1.8 lakh crores that you have invested as equity assets in Birla Sun Life, what is now the bias? Is fresh money moving towards large caps, or are you dipping your toes into maybe frontline mid caps or small caps? What is your mind telling you when you look at the overall picture of the BSC 500 or the NSC 500? Where is valuation in your favor?
We have been kind of since the last 6 months, 9 months, we've been trying to saying that large caps look relatively better pace. Okay, the valuations look relatively attractive. Mid and small caps were expensive, and there was some amount of froth which was there. But I think that froth to a large extent has corrected in the last 6 months, I would say, as I said, from September onwards. While the index has only fallen so much, the headline, but many stocks are down like 30%, 40% from their highs. So I think while we still continue to, we still find that the large caps still offer a better risk reward from a valuation standpoint, and would want to have a larger allocation. But this is a good time to take some risk, look at opportunities in the small cap, mid cap space, which can give you a higher growth, and build up a portfolio for the next, say, 3 or 5 years, and which can give us opportunity to generate alpha in the portfolios. So I think selectively, I think it's a get time to add risk to the portfolio. Look at some of these stocks which have corrected either because of short-term concerns or the slowdown what we saw in the last 1 year, and try to accumulate these names for a slightly longer term view.
Mr. Patil, in the gentlest possible way, if I may ask, will you be in the mid cap and the small cap space? Will you be backing your old horses, or will you be buying fresh horses in this market correction that has happened?
So while we continue to consolidate some of the companies which are there, are high conviction ideas which are there, we continue to back those. At the same time, we are always looking at fresh ideas, and especially companies or sectors, okay, which have gone through a lean phase, right, in the last 1 or 2 years. Within that sectors, especially more as a contra or the counter-cyclical approach, okay, which we also have in our portfolio, to look at stock sectors which have underperformed because of short-term concerns, and where, as a result of that, the valuations have also corrected, and where the outlook could improve going forward. I think in those areas is where we are trying to look at new ideas, or as I said, uh, uh, new stock ideas which we would want add to our existing position. And these could be in, say, for sectors like which are wonderful, like chemicals, for example, right? Which has underperformed in the last 2 years, 1.5 years actually. And we see
Okay.
probably that is which could improve slowly going forward. Metals has also been an underperformer. Again, with the now the trade deal, what we have seen getting globally, I think the growth concerns on the global front would probably kind of slow down. So that's could be another contrarian sector to look at. And consumption itself, as I said, right? Some of the consumer discretionary stocks which have underperformed with the good quality names in that which were expensive earlier. Okay, they couldn't fit our valuation frame. These are the ideas now which we are looking at to expand our portfolio.
Right. And Mr. Patil, maybe just to celebrate your presence on Business Today, the Nifty is now above 24,900. This is almost a 900-point rally, and the index itself now at a fresh 5-month high. So obviously the risk on trade is in front of us. And let me just press my luck again. You seem to be in a mood to share a lot of details on your portfolio. We will not be taking stock names, but in the last maybe 3 months or so, what are the large caps in terms of sectors that you've added?
You're seeing which sectors which we have increased our
You,
positions, you say?
yes, you mentioned that the bias is bias is towards large caps. I
Yes.
understand you will not be naming stocks. If you can, wonderful. But in the last 3 months or so, where are the sectors, what are the sectors in which you have added to your existing large cap positions, or maybe added fresh large caps?
Yeah, so I think from a sector standpoint, we've increased our exposure into the banks, okay, and the financial services sector, okay, more on the private banks, because that's where we find better quality and valuation comfort. So that's clearly one sector which I would say where we have increased. Apart from that, we haven't seen any major shifts, but at the margin, I would say that some of the retail companies, uh, consumer durables are the sectors, okay, where we are looking at in this correction, where we feel that the long-term growth for India, right, because of higher penetration per capita income going up. These are the sectors, okay, which can continue to exhibit a stronger growth in the coming years.
Okay. Mr. Patil, thank you so much for your time. As always, it's such a pleasure to host you. It's now almost 21 years for you at Aditya Birla Sun Life AMC, and I've been tracking you since 2006, when I think the biggest position in your portfolio was Bharti Airtel. Let's hope to meet more often and get such wonderful ideas from you. as to where the markets are headed and what asset allocation should be. Thank you for your time, sir.
Thank you. My pleasure.
This, ladies and gentlemen, was Mr. Mahesh Patil, CIO for Aditya Birla Sun Life AMC. The broad thrust is that large caps work better than mid caps and small caps at this point of time. Aditya Birla Sun Life AMC is raised exposure to the banking sector, in particular private banks, over the last 3 months or so, and they believe that overall the risk on trade is improving for equities at this point of time. Earnings growth in the coming quarters could be in the vicinity of double digits, and that the macro picture on the banking sector, because of increased liquidity, potentially more rate cuts ahead, would improve. The geopolitical situation for equities is improving, with 2 or 3 large trade deals that the US has done with UK, China, more in the pipeline, and domestic IT, the top performer today, is one of the biggest beneficiaries of this US-China trade deal that has happened, mainly because recessionary fears in the US will recede. That is good for Indian exporters. I hope you enjoyed this conversation as much as I did, but stay glued to the market. We are now joined by Mr. Nilesh Jain, and we'll be just joining back after a short break.
Well, we are in Bangalore and we are attending this fabulous AI and innovative tech conclave which is happening